Looking at the performance by sector over the past year in the REIT market, we can see that there was a great deal of dispersion. Data center and industrial logistics were among the strongest, posting strong positive total returns. At the opposite end are those sectors that were heavily impacted by COVID and frankly were weak prior to COVID as a result of long-term trends. Retail, office, and hotels were all down dramatically in the last year, more than 20%, far worse than the US REIT average of about 6.5 percentage points. Comparing 5-year sector performance, we see similar trends. The trends we saw on the last page are not a recent phenomenon. Global REITs produced about a 6.7% or 38% cumulative total return, but again, there was a tremendous amount of dispersion between sectors. Industrial, data center, telecommunications, infrastructure dramatically outperformed the overall REIT index in those non-growth REIT sectors. And if anything, the pandemic has encouraged and trained consumers to do more of their shopping online. Office will suffer from the work from home trend probably for the next decade, and it will erode office demand. Hotels, clearly under a lot of pressure today, but once things return to normal, there could be a lot less business travel. There will be more virtual conferences, more meetings such as this, and that will reduce the need for business travel. And business travel is an enormous driver of demand for hotels. We remain in the early phases of these trends, and we are very optimistic about the favorable trends for data centers, towers, and industrial. The large dispersion in returns has been a function of a large dispersion in earnings growth. The earnings growth of the sectors the fund is most focused on are highlighted in blue at the top on the right-hand side of this chart. The growth is dramatically better than that of the overall REIT market. Think about pre-COVID versus post-COVID earnings growth. The overall REIT market is only expected to get back to pre-COVID levels of earnings growth sometime in early 2023. But the growth of the growth sectors, building off of their uninterrupted growth the last few years, will be much higher in 2022 than it was pre-COVID. In fact, the growth REIT sectors are expected to have about 7.4% more earnings growth than the overall REIT market, which is expected to only be flat. Further, we believe that these growth estimates for the growth sectors will prove conservative, as in fact they have over the past 6 years, and that ultimately earnings growth will be better than what is forecast today. Valuation is always the most important factor, but in this case it may perhaps be the most impressive. Not surprisingly, towers, data centers, and industrial REITs trade at higher earnings multiples than the average REIT. If we compare the PEG ratios, dividing the current FFO multiple by the forecast FFO per share growth, we can see that all REITs trade at a PEG ratio of 4.35. However, when you run that same calculation for the data center sector, the ratio is only half of that level at 2.19. For industrial and cell phone tower REITs, the ratio is about 3/4 of the overall REIT level at 3.78 and 3.70 respectively. Higher multiples are not a constraint on growth REIT's ability to generate higher total returns. Further, as this chart shows, growth REIT multiples have fallen in recent months, largely as a result of good earnings growth and a little bit of a pullback in price. Growth REIT valuations are more compelling today than even in the recent past. We encourage investors to take advantage of this small dip and buy the growth REITs.